A viewer was interested in the relationship between calendar spreads and short straddles and the relationship in terms of P&L between these two. We're going to talk about that, some unusual activity that we saw today, and some upcoming catalysts. Today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where I take your questions about options strategies, and we're actually going to sort of get started with that today and then maybe move over to some names that saw some unusual activity and some upcoming catalysts. And the reason we're doing this is because we got a question from one of the regular viewers since the last live stream. Ranjana Gupta was asking, and perhaps we can pull this up on here so that you all can see it, but there's a lot to it, so I'm actually going to read what is written there so we can go through this together. So, hi Mike, I have a couple of questions regarding time spreads. Do the terms time spread, long call calendar spread, and calendar spread all refer to the same strategy? Can puts be used for time spreads? If so, how do we decide between using calls or puts if both strategies are neutral? I noticed the P&L diagram for a calendar spread looks similar to that of a short straddle. The difference being the latter has unlimited risk. So can a calendar spread be used as a limited risk substitute for a short straddle? And then more specifically, what do you think of the 29 strike, October 25th, March 21st calendar spread on Pfizer? Okay. So it is absolutely true that the P&L, the estimated P&L, if you were looking at something like options play, which I also happen to have up on one of my screens, will give a P&L profile for calendar spreads that looks remarkably similar to that of, depending on which way you're trading it, a long or a short straddle. Quick point I would make, or strangle, I guess, is somewhat similar as well. Quick point I would make is that there's a little bit more to it in the sense that with a short straddle or strangle, when you're looking at the P&L, you're looking at it as of the expiration of the entire option strategy. So in this particular case, you're going out to October 25th. So let's just take a look at a short straddle for Pfizer out to October 25th. So we'll just find that strategy here. There we are, short straddle. And we'll go to October 25th. Assume you can get it off at mid-market. And you get a P&L profile that looks a little bit like this. And the break-evens for that strategy at expiration are going to be the strike price of the short straddle plus and minus the total amount of premium collected. So the upside break-even will be the strike plus the amount of premium collected, net of fees and expenses, and the downside break-even will be the strike minus the premium. You will see profits between those two levels, with the peak profits achieved at the short strike price. So what are the risks associated with this other than the fact that the stock could move sharply outside of those break-evens? One of them is, of course, that, well, it could pin, which means that the stock could land directly on the strike at expiration, and then you have some question if you don't close it about whether or not you will be assigned on either option, if they're not an automatic exercise, which they would be if they're at least a penny in the money. So that's one potential risk, that you could potentially be assigned either on the put or the call, or in a very unusual circumstance, you can imagine that it pins exactly and both sides get assigned. It's not likely, but it is a very remote possibility, in which case you would walk in flat. So that's one potential risk. When you start dealing with calendar spreads, and it's a very good question, because we often talk about call calendars or put calendars. Calendar spreads, in general, assuming an arbitrage-free market, it would be reasonable to say that you can use call spreads or put spreads when you're trading calendars somewhat interchangeably. But the habit would be that if you're trading strikes that are higher than the current price of the underlying, you're probably using call calendars. And if you're choosing strikes that are lower than the current underlying price, you're likely to be using put spreads. Sometimes you can use both, depending on whether you're hoping to take assignment on one leg or the other. So there's a couple different things that are going on there. But to illustrate this, let's put in a straight calendar. And again, we're going to get short the October 25th at the money options, which in this case are the 29 strike. And then choose a longer dated strike, which in your case was the March. So we'll just go out to March regs. And you get this strategy. And you can actually, if you're looking at my screen, you can see that these two structures look very similar. That they're going to see peak profits at the strike, the 29 strike, and that breaks, the probability, the break-evens are going to be to the upside and the downside. Let's just take a look at the difference between the theoretical break-evens. Now, it's a theoretical break-even when you're dealing with a calendar. It is a break-even absolutely when you're dealing with a straddle. And the reason is that part of what determines the profitability of a calendar spread is the value of the longer dated option at the expiration of the nearer dated one. So in this case, what is the value of the March 29 calls going to be on October 25th? And that's partially a function, of course, of where Pfizer is. But it is also a function of where implied volatility is for March. And so in this particular instance, it's calculating these break-evens as an estimate, right? So the break-evens in this are making an assumption about what the implied volatility of that longer dated option will be in October. And the important thing to think about here is that there's a lot of things that can play into this. The general level of volatility in the market, how volatile Pfizer is as a stock, whether there are upcoming catalysts that are or are not captured by the expiration that you're going to continue to hold or own, or even if you're going to unwind it, that's going to play into it. And of course the term structure. So just as a reminder, I'm going to pull up the term structure for Pfizer right now. We can pull that up on a screen here. So the term structure is simply a graphical representation of the implied volatility of options through time. And so in this particular instance, you're going to be selling these October 25th options, which are trading around 21 vol, and buying these March options. Those are somewhat higher. Those are trading 23.8. And what we're going to be trying to establish is how much is that volatility likely to change between now and October 25th. Now the answer is probably not that much because as we can see here, a lot of sort of the volatility that's baked into the cake, if you will, is coming, as we highlighted on Monday's live stream, a lot of this is coming from election-related volatility. So whether you're dealing with the indices or single stocks, you're going to see that there's a notable bump in the implied volatility, the price of options, if you will, for the November 15th expiration. And in those instances where there's an expiration that captures earnings in this, or something else that happens prior to that, you're going to possibly see a bump in that as well. So it is true that making all of these assumptions and that all of these assumptions come to pass, that yes, a calendar spread has characteristics that are a lot like a short straddle. And it is also true that if you buy a calendar spread, the most you can lose, assuming you don't just let both legs expire and one of them's in the money and you end up getting assigned or take automatic exercise and just wear the position into something that it was never intended to be in the first place. When you are in a long option strategy, generally speaking, it's safe to assume that your max risk is the amount of premium that you spent. So in this particular example, the max risk on this October, excuse me, let me just kill that, that the max risk that you're taking is $1.12 a share. Because that's the total amount of premium that's being spent. And that is considerably, so even if you look at this risk profile, it looks very similar to the short straddle, but indeed it's actually very, very different, because the short straddle, you're collecting $1.40. Beyond this, if Pfizer moves very sharply, the amount of risk you take can be significant. You can think of the downside risk if Pfizer went to zero. It's not going to do that. But you can think about the downside risk if it suddenly went to zero as being the break even, which is $27.60 a share, give or take. And the risk to the upside is, in theory, unlimited. Again, that's not entirely realistic. People are willing to go short stocks from time to time, and they're not, thinking about the risks as being unlimited. But of course, there isn't any theoretical cap on how high a stock can go, particularly if something's in a short squeeze or something like that. So I do like calendar spreads for this reason. But bear in mind that in order to make the same amount of profit, so let's work through this a different way, which is, imagine that your thesis is that Pfizer is going to be $29 exactly on October 25th. So that's your target price. You're shooting for it to get right to that level. If you short this straddle, you would collect your $1.40 a share. So not a terrible rate of return for about a month. By contrast, if you traded the calendar, how much money would you make? Well, it's going to be, at best, you can hope to collect all of the premium from the short side. And that by some miracle, maybe longer dated implied volatility rises, such that you don't see any losses on the long leg. So if implied volatility rises, and it would have to rise pretty substantially, because it needs to rise by enough to offset the decay of that option. Otherwise, your max profit is going to be less. So in order to adjust for that, you would need to trade more of these, right? So you could buy the longer dated call and sell the nearer dated one, but you would have to do it a couple of times to expect to realize a similar amount of money. Maybe 3 times would be a reasonable way to think about it. The logic being that you're going to have to offset some of that decay, and you're going to have to collect all of that premium. And the short straddle is 2 legs by itself. You're short a call, you're short a put, you're collecting $1.40 in premium. So you would need to collect more than $1.40 in premium on the October 25th expiration to achieve a similar result. So that's okay, because you are also taking less risk at the wings. But these are considerations that you should think about. Now, with respect to trading calls or puts, how much of a difference does it make? Well, in fact, not a huge amount. Let's do, whoops, this put in a different strategy here. So let's just do this. That's the straddle, excuse me. So now we're going to go to the calendar, and we're going to change one of these, or both of them. Let's just go to puts. Okay. So same structure, effectively. You are going to get into the same kind of risk profile, and you're going to notice minor differences. So the amount of premium that you're going to collect or spend on any of these options is going to be a function, obviously, of where spot is relative to the strike, and carry cost, right? So that's essentially the overnight interest rate, the net present value of any dividends for the respective options. All of those things are going to play into it. But in general, the payout profile is going to be similar for call calendars and put calendars of the same strikes and expirations. And they're, whatever differences there are very likely going to be just simply related to, cost of carry types of issues. Now, one of the strategies that I have previously pointed out that I tend to like are strangle swaps. And one of the reasons I like strangle swaps is because the likelihood that the stock is exactly on expiration where it is right now is not that high. I mean, of all of the potential values that it could be, the forward is probably the highest probability, but it's not a high possibility because there's a complete distribution of possible future prices. So the way that one can accommodate that is by trading a strangle swap instead, and I'll go into the calendar. We'll go into here, and we're going to just say, okay, you're going to sell, and let's just spread these out a little bit, and we'll just say that's a 30 strike call and a 28 strike put. So you end up with this. That's the short strangle, and then we can add a longer dated strangle. And you were using March, so we'll just use the same strikes, or as close as we can get to them, because we don't actually have a 28, we have a 27.5. And you end up with a structure that looks a bit like this. So you're going to push those break-evens out a little bit. You're going to bring the whole thing down a little bit, but you're going to flatten it out. And basically, usually, you have a chance of improving your probability of profit. And, it's, to me, especially when you're using longer dated options, out, and I'm going to refer to March as being longer dated, but, we'll think of those as being long dated options. We'll think of that as being close to leaps or beyond. Longer dated, beyond 6 months or so. And, sort of midterm being beyond 30 days, and then short dated being within. You'll forgive me if I get a little loose around those sort of guidelines that I just set in future live streams, but it's just a way to think about it and how I'm referring to it here. So that's just another way to play it. I will say this very simply, and that is that, of course, you want to manage these positions through both expirations and keep an eye on things like dividends and strange borrow conditions, because that always increases either the risk that you are going to be assigned on the short side, or in rare cases, the possibility that you may want to think about exercising a longer dated option, or at least trading out of it. It's not generally going to be the case. It's not common that you're going to have a longer dated option and a long call option, for example, and it becomes optimal to exercise it early to capture a dividend. But if you're ever in doubt, you can always look to close that position before the ex-dividend date occurs. Okay, so I hope that helps. Pfizer's a pretty low vol name, so not a whole lot of premium coming in on that one. But again, not likely going to be a whole lot of movement to it either. Just going to quickly take a peek at the events calendar for it and see whether we have anything between now and the 25th. We don't. They're going to be reporting earnings on the 29th. And there's nothing else really in there. And of course, as we've pointed out, other than earnings, it does appear that there's a lot baked into the cake for the election in a host of stocks. Okay, so with all of that said, let's just quickly take a peek also at some of the events that I saw coming up on the calendar here. And let's see, is that, I had that on another screen, and where did I put that? Here we are. You don't need to look at that one. Okay. So these are all names that actually were traded well above average volume today. Some of them, it's probably not that helpful for me to share it now, just because the event that's the reason is not really tradable, because in the case of Accenture, CarMax, and Jabil, all of these companies are going to be reporting tomorrow, but they're going to be reporting before the open. So unless you happen to, and maybe you own the stock, and you can trade stock after hours, but you can't trade the options, so that's not going to be all that helpful. Accenture is implying about a 5.3% move, higher or lower. Call volume was more than 300% above average, whereas put volume was only about 200% above. Like I said, they're going to be reporting pre-open tomorrow. CarMax, sort of a similar circumstance, although implying a much bigger move. This one's going to be interesting because one of the things we heard today was that auto loan delinquencies have really shot up. And we also have seen that some automakers are starting to see real buildup in their inventory. Stellantis brands in particular. So Stellantis is Chrysler, Dodge, Jeep. And that's, obviously not such great news, and it'll be interesting to see whether that's going to affect CarMax. And actually, we would just pull a chart up on this thing really quickly to sort of get a look. And where are we relative to the 150? Oops. So, yeah, I don't imagine that the news coming out of them is going to be that stellar. So, in any case, we're just violated the 150, and that's, combining that with the auto loan delinquencies, with the buildup in inventories, helping a little bit could, of course, be lower rates. It's interesting because, for mortgages, it's going to be anchored more around the 10-year, and we saw some steepening, and yet what was reported so far this week is that with this rate change, there was a 20% uptick in refi applications on the mortgage side. And I'm not sure how profound a benefit that is just yet. But on the auto loan side, that's anchored around much shorter dated rates. And so it does two things. One of them is, of course, that it could, if someone's just getting regular bank financing, it could reduce the cost of that. But additionally, it also makes it more affordable for auto manufacturers and others to provide rate-based incentives to push additional sales. And so I would probably expect that for Stellantis at least. Some other brands, for what it's worth, their inventory numbers are very, very different. Toyota, this appears to be the case. I think they had, when I was looking at the statistics earlier this week, Toyota had the lowest on-lot inventories. And I was kind of surprised by some other brands. So, for example, Land Rover was in that mix. And then sort of in the middle tier, were some of the luxury brands. But Stellantis is clearly the one that's got some problems. And actually, other news, this is, unrelated, but I'm just going to mention it anyway, and we'll just sort of see what the options flows are looking like here. Harley-Davidson, which is sort of the ultimate consumer discretionary product. They have an aging demographic, which is a little bit problematic. And now we have news that several dealers are closing or walking away. There's one outside of New York City that apparently is closing. There was one in Florida that I saw that was closing. And that's kind of interesting. The auto dealers, these things are capital intensive and generally speaking considered to be very valuable businesses. But Harley has 3 dealerships. New York, there's one in San Francisco, and another in Florida that I saw that are all just closing outright. And to me, that does not spell a super healthy recipe for those guys. So just something to think about there. Other companies that we're seeing unusual options flow today that do have upcoming events that actually there is time to trade. Walmart. So Walmart's going to be reporting. Actually, no. So Walmart's not reporting earnings. They have they're giving a presentation that's going to be tomorrow afternoon, and we saw more than 2 times the average daily call volume. Actually, when is Walmart reporting earnings? So we're sort of between earnings here. That's November, but they do have a corporate presentation coming up tomorrow, and there was a lot of call volume ahead of that. A lot of times when you have those presentations, it's sort of an interim look, and if people are expecting something good could come out of it. And if you've ever attended some of these, whether it's bank research department funded events. I've gone to a couple of these where a bank is holding an event and they get corporate management in there to talk about what's going on. It has been my experience that it's usually going to be a good story. They're kind of pitching to the institutional investor class. Oftentimes they're probably going to decline to participate if they don't have something good to say. So you can kind of look at those events as, in my experience, I would say, as being neutral to bullish. And that's probably what's prompting some of this flow. Now, one of the ones that I thought that's kind of interesting, reporting tomorrow after the close, and they are reporting earnings, and where we did see some unusual put activity, was ticker MTN. Some of you will know immediately what this is, but MTN is Vail Resorts. Pretty beaten up stock, and this is another sort of big consumer discretionary kind of thing. This, it's an expensive sport, and for people who, if consumers are a little bit more pinched, I don't know. It's probably going to be around the margins, I would say. I've kind of been waiting to see what the Icon and Epic passes are doing in terms of, whether they're really trying to prompt people with any kind of specials to try to get them to up. We haven't bought our Icon passes yet because I have to see what the kids' schedules are. But for those of you who don't know, Icon and Epic are passes that work at a variety of resorts. A lot of these resorts have either teamed up or are all owned by the same parents at this point. And it allows you to get essentially unlimited lift tickets or lift access at your home resort, and then oftentimes, a week or more at other resorts that are sort of in network, if you will. So for those of us in the Bay Area, that would mean things like Squaw Valley, formerly Squaw. It's now called Pacific Palisades. And then you can go to Deer Valley and places like that on it. In any case, my guess is, and this might be gauged more accurately by taking a look at things like Airbnb and VRBO prices, which I probably should have tracked before I hopped on today. I may actually do that tomorrow. I'm kind of interested in this one because that could actually that could be a little bit of a canary in the coal mine there. But that was interesting. This one did trade above average put volume today, and they're going to be reporting tomorrow after the close. Okay, so with that, let me just hop over and see where our questions, if any, are. And let's see here. Okay. So, Monday morning quarterback, AMQB. Do you ever get insight from unusually heavy volume? I'm long GENI, betting infrastructure for the NFL, Premier League, etc. A Danny Moses favorite. So, yes, it is a measure of sentiment. It also can be self-fulfilling. So let's do two things here. We'll just take a look. This is Genius Sports chart over the last 6 months. And now we can just take a quick peek and take a look at the call volume over the same period. And you can see the calls outpacing puts in this thing significantly, but let's just blow this up real quick. So I'm going to do that. Get a little child window in here. And we'll take a look at this one over the last 6 months. Okay, so here's the call volume, if you can see that. And that's the stock. So it's not the end-all be-all. Unusual volume. So a couple of things you want to focus on if you're looking at unusual volume to see whether it really is sort of a confirmation of the directional bias that you have in mind. So if you are bullish in Genius Sports and you see unusual call volume, number one, is it buying? And this is a question I get pretty often, which is, well, how can you tell? How do you know if the volume is buying or selling? So I don't know, each of you will probably be using a different platform. But the first thing you want to do is you want to take a look at the volume and see, number one, is it likely to be opening or closing? You can see the open interest in this column I'm highlighting. This is today's volume. And the other thing you want to, just as a quick first look, this isn't confirmation, but it's a good first step, is the implied volatility of the option you're observing going up on that associated volume. And if it is, that suggests if the option's prices in implied volatility terms are rising along with volume, they're probably being purchased. And if they're declining, there's a chance that they're being sold. Bear in mind that you need to consider whether an event has just come and gone. So implied volatility, we've talked about this a lot, will fall right after an event. So if something was 80 vol yesterday and they announced earnings after the close and you come in today and it's trading 50 implied volatility and you see a lot of volume, that does not necessarily mean that it is being sold. It is possible that that's being bought. So to then establish that, it's best to try to take a look at it in the context of the actual prints, assuming that you don't have some other tool which can sort of tell you that. So in here, and I'm just going to take a look at this for one day, I'm taking a look at the print. In this case, it took place over here, so there was a big chunk of volume that took place around 10:34. 439 contracts at that particular moment. Doesn't sound like a lot, but that's almost 44,000 shares worth. And where did it trade relative to the bid-ask spread? So I'm going to get rid of the mid here. So this is the bid vol in green, and this is the ask vol, right? So that's just thinking about the bid-ask spread in implied volatility terms. And what we can see is it looks like that print happened right on the ask in implied vol space. So that suggests that those options were being purchased. We can actually delve into this more deeply if we chose. We can actually go back and try to take a look at the actual print. Looked like that was over 100 contracts, so I should probably be able to find it. So 346 trade at 10:34, and this was probably, it's kind of an odd lot. So looks like somebody was working a trade electronically, which is confirmed by this moniker here. So you may not have access to condition codes, but that's what that is. Just tells me if this said ME or contingent, this could say R6, for example. I can get a couple different condition codes, which will tell me things about the trade as it was reported to the tape. That may be relevant. So was it part of a multi-leg trade, or did it just trade electronically? Was it crossed? Was it canceled? Those types of things. All of those are important. These things are rules that are pretty strictly enforced. As a trader, I can tell you that the regulators are very finicky about how you report trades to the tape. So, we would usually be pretty diligent about this. R6, by the way, if you ever see that, if you have a system that allows you to check it, that just simply means that it's related. It's derivatively priced, actually, is what that will mean. And so you could have somebody who's trading stock and options together, doing a buy right, for example. And so then you could, if you knew that, then you could go then and look for the corresponding print in another option or in the underlying stock. But okay, but just doing this now, so I can see that the trade took place at 10:34 and 40 seconds. So I can take a look then and say, all right, well, what was the market in that option right before that happened? And then we can see the print within that context. So we know the trade took place between 10:34 and 10:35. What was the market at 10:34 and where did that print take place? So I'm just going to go back to some time before that. And there's that trade. We can see it, 346, trade is 155. So the market was 145 bid at 155. And it traded electronically. And it was 145.55 coming out. Looks like that was a buyer. So, now one of the things you could potentially see also is, and you have to keep your eyes open for this as well, if you're going through this exercise, is that if you see a print take place, there is one other possibility. And that is that if the market's 145, 155, 145, 155, 150, 155, and the ask size is essentially declining, the other possibility is that somebody dropped a limit order on the book, let it sit there, and if the stock price is migrating up, then it essentially, became a marketable order, and then it ended up trading as a result of that. So you had a non-marketable limit order that became a marketable limit order as the price of the underlying instrument rose into it. But the way we can sort of see that is by monitoring the underlying price. Was the underlying price rising? Well, if you've been following along, you can see that I have it all the way in my right-hand column. It was not. So I've got three things that are effectively sort of all coming together to tell me whether the options were bought or sold. So what's going on here, and why would this suggest that a stock could go higher? Well, there's a couple things. One, there's sentiment, which is that if you see a lot of call buying, it suggests that there is bullish sentiment in the underlying. That's why people are buying calls. Okay, so that's one possibility. There's a reflexive possibility as well. And what I mean by reflexive is that when someone trades the options, if they buy them from market makers, what do market makers have to do in response to that? They have to hedge. And when they hedge, what are they going to do? They're going to buy the underlying stock. So you actually create some measure of additional support for the stock simply by going out and buying those calls. You buy 1,030 delta calls, that's 30,000 shares of the underlying stock that the market making community needs to go buy. I've had auto hedgers that did this quite disastrously, it should be said. I had a situation where somebody came in and lifted 1,000 calls in Federal Express from me many, many years ago, and we had an auto hedger, and the auto hedger didn't have the smart logic not to go out and try to plow all of those deltas immediately. And the specialist on the New York managed to print me up about $2 just inside the obvious error rule. Bitter enough about that I can relay that story 11 years later and still be quite ticked off about it. But the point is that if anybody was looking at Federal Express that day, they would have said, oh, well, look, all these calls traded. And then, oh, look, the stock traded up. Yeah, well, it traded up because yours truly had an unintelligent auto hedging algorithm that bought the stock more aggressively than it should have. But it's reflexive buying that was a result not of my having bullish sentiment on Federal Express at that time or not, but just responding to my market making flow on the option side. Okay, so next. MM says, hi Mike, I'm thinking of an 950 iron condor on Costco, expiring Friday to capture earnings. Any thoughts? My first thought is, what are the other legs of your iron condor? Because an iron condor is a four-legged strategy, and you only gave me two. But we'll start with a short strangle, 850, 950, and go from there. So I think I've said this before about Costco, which is that love the company, love the business, don't love the valuation here. Many will say, many intelligent people, many people more intelligent than I am will say that it has always traded at a rich multiple. That's true, but never as rich as it is right now. More than 50 times forward earnings, 1.5 times sales. These are pretty heady numbers. It usually trades, we'll call it 10 turns richer than the S&P. So 24 gets you 34 on that basis. 52.5. Wow. Now, in support of that, one could say that they've kept some things quite steady for a long time, and they have the ability to extend those prices. For example, their subscription fees, or membership fees, I guess we should more appropriately call them. They held those steady for some time. I think they recently increased it. I don't really think you're going to lose a lot of members for that. Not based on my experience going to Costco, which I've done at least 2 or 3 times within the last 5 weeks. I've also noticed, by the way, and maybe you've noticed at your Costco too, that rather than just having people at the door checking to make sure, just waving your card to make sure you actually are a member, they actually have scanners now. So we have to scan the barcode on the back of the card. And I don't know whether that was kind of a Netflix membership sharing concern that might have been going on. I mean, was it even a thing? We know it was a thing for Netflix. People would pay their fees, and then everybody in the family and 10 friends were all using the same login. Was that actually happening at Costco? Not that I'm aware of. I haven't really heard that complaint or anything mentioned about it. But it did occur to me as I had to scan it the first time that I thought, well, if you were going to increase your fees or do so more regularly than they have done, you would want to make sure that people are who they say they are. So that's the first thing. And you're keeping closer track. Perfect track? No, but better closer track, yes. So anyway, let's just take a quick look at what a condor might be. So first of all, a condor is a 4-legged trade. You can do a call condor, you can do a put condor, or you can do an iron condor. And I'm going to compare. Good. Oh, okay, 20 wide. There we go. So we got the other strikes. So let me just illustrate something, because very often when we are dealing with these strategies, they look like synthetic equivalents. In fact, Ranjana Gupta was asking us specifically about the relationship between calendar spreads and short straddles. So in the case of condors, this relationship is much tighter, because you're actually going to be trading, whether you trade a call condor, a put condor, or an iron condor, in all cases you're going to be, if you're comparing like for like, trading the same expiration and the same strikes. And let's illustrate that really quickly. So first, let's imagine that you are going to trade the call condor. So I'm just going to go bang. We're going to do a call condor. And so our strikes are going to be 830 on the downside, 850, 950, and 970. And my earpiece keeps popping out, so sorry for fiddling around with that constantly. Okay, so if you're going to trade the condor, in all cases, if you're trying to assume that it's not going to be a big move, you will be long the wings and short the middle. Now, when you're dealing with synthetics, I think this is an important thing to remember, that a long call spread and a short put spread can be synthetic equivalents of one another. The important thing to remember is that you will always be long the same strike and short the same strike. whether you're using calls, whether you're using puts, or some combination of them. Okay, so here we have a call condor, 830, 850, 950, 970. So we'll move on, and we will create a put. Oh, actually, you know what? Oh, you didn't mention the expiration, but let's assume, okay, for simplicity, let's just assume that you are talking about expiration for next week. Okay? Oops, that's going to be here. This week? Oh, okay, yeah. Okay, there we go. So there we have it. All right, so this is the call condor. We're going to do the same thing with the put condor. So we're going to use this as a combination of a Costco conversation and a teaching moment conversation. So now we're going to do puts, exact same thing, and you're going to see just how similar this is. So remember what I said. Doesn't matter whether you're using calls or puts, but it does matter that you're going to be long the same strikes and short the same strikes. So you're going to be long the 830. You are going to be short the 850s. You are going to be short the 950s. And you're going to be long the 970s. All right. And now I have to use the same expiration, of course. So there we go. So call condor, put, and now the iron. So in the iron condor, you use puts for the strikes below the money, usually, and calls for the strikes above the money, usually. If you use in the money options, so I used calls for the low strikes and puts for the high strikes, we call that a guts. Very rare that anybody would ever trade that, but for whatever it's worth, that's what that would be called. If you needed to slap a name on it, which isn't really all that important, but whatever. So again, we're going to use the same expiration, which is Friday, and we're going to use the same strikes, and we're going to be long the same ones. So you're going to be long the 830s, long the 830 puts, short the 850s. I have to switch those to puts. I will do. Okay. And then we have to, so those are going to be puts. And then we need calls, and we're going to be short the 950 calls. And we're going to be long the 970s. Okay, so there you have it, folks. An illustration of the similarities of these condors, regardless of whether you're using calls, puts, or calls and puts. What do you want me to do? Sorry, click here. Oh, yep. Oh, yeah. So there we go. Thank you for that. Somebody in my ear was just making the point that we can flip all of the cards over and now see the relationship between these. Now, bear in mind that you're going to see some differences here that are related to the assumptions about the executions you're going to get that will be a little bit different. And I'm now going to talk a little bit also about one of the reasons why I would probably prefer to use an iron condor over a call or a put condor in most circumstances. And the biggest reason for this is that when you start trading deep options in high dollar stocks, it is not uncommon to see fairly wide bid-ask spreads. So if you're legging your way into this, you have a bigger chance of, having a fat finger, bad execution error, executing the trade effectively at a bad price if you're trading deep calls and deep puts. So I would, rather see you say, okay, I'm going to sell this put spread. I'm going to sell that upside call spread. And that's another thing you can do, by the way, is leg your way into it that way. Sell the call spread, sell the corresponding put spread, and trade it that way. Sometimes it's a little easier to get it off in the complex book, big multi-leg trades. In theory, the pricing engines should be combing that and looking for them, but you will find that there are sometimes situations where it's just more likely you're going to get the trade-off, or that you could leg your way into it in pieces. by trading out of the money options. And also, your intuition should tell you this anyway, not just the fact that the bid-ask spreads are wide, but delta of an option is the price sensitivity of that option to changes in the price of the underlying. The higher the delta, the more sensitive the price of the option is going to be to a dollar move in the stock, higher or lower, while you're executing the trade. So if you're trading lower delta options, you're going to have less sensitivity on those leg prices. So all else equal, I like that. Okay, so now let's just take a look at this. According to Options Play At Least, the probability of profit of the iron condor that you have selected is almost 78%. That's pretty good. But we should bear in mind that there is the context of the earnings event versus the probability of that event, in a more generic sense. So why don't we take a quick peek at Costco's historical earnings results and see just how big these moves have been. Okay, so, and we can actually just quickly flip back here. So what were our break-evens? Our break-evens are 846.55 on the downside. So remember, your break-evens on the condor trade are going to be what? Your short strike, your short downside strike, less the premium collected, and your short upside strike plus the premium collected. So, and one quick point here I would also make, which is that, your yield on this trade is, you're collecting $3.50 on a $900 stock. So a relatively small percentage of the current stock price. This is one of those, now, the smaller the yield, the greater the probability of profit. We can actually illustrate that if we wanted to, simply by, and I'm going to switch this one to a condor, an iron condor as well, by just switching those to calls. So these two trades are now identical, but I'm just going to quickly adjust my strikes a little bit to just illustrate something, which I think is kind of important. And that is that, so I'm going to tighten this up. So I'm going to just say, the 930, 950 instead of the 950, 70, like that. So notice here, the probability of profit is only 60% versus almost 78% by having brought it in $20. But you will also notice that I'm now getting $7.22 a share over the course of between now and the end of the week. So the relationship between my probability of profit and my yield are inversely related. But there's something else that I think is also important to take a look at, and that is take a look at your max risk. Oops, sorry. So the max risk has also gone down because the most you can lose is going to be the distance between the strikes, less however much premium you collected for the whole structure. Now, the stock can only be one of two things. Well, one of three things, really. It could either be higher at Friday expiration, lower at Friday expiration, or somewhere in the middle. And if it blows through your strikes, then the distance between the strikes less the premium you collected is how much risk you're taking. So your probability of profit goes down, but the amount of max risk you're taking is also going down. So I want you guys to really think about the dynamic that's at play there, right? So for me, I would probably be looking for probabilities of profit somewhere that are, in the 66 to 70% range, partially because I'm never that crazy about these things where I can make a really tiny amount or I could lose a lot, right? And actually, there's a related question here. So James Forbin says, if the spreads are tighter, you can buy more contracts. Yes? So James, I'm not 100%, I'm going to assume that one of the things you're talking about here is the spread between the strikes. So that's something else, right? Not just the bid-ask spread. So the actual lit bid-ask spread will adjust my willingness in terms of sizing, but generally speaking, I'm not trafficking in spots where the liquidity and the pricing are really at odds with one another. I just don't like those, tar baby trades, if you will. What's a tar baby trade? It's something that you get into and you can't get out of. It's based on that old children's fable. Or Roach Motels, right? They used to have an ad. I don't know if they still have it, but you can get roaches get it. They check in, but they can't check out. Really want to avoid those types of things. But let's just take a look at what happens if we tighten these strikes up. So rather than 870, I say, okay, well, I'm going to use the 865s now, and I'm going to use the 935s. Okay, so my probability of profit is going up, and the amount of premium I'm taking in has gone down, but the max risk hasn't necessarily gone up a great deal. Yeah, so he's James, right, exactly. So yeah, this between the strikes, you're actually saying, okay, 10, but we'll do this one more time so everybody can watch and sort of take a look at the impact. My probability of profit has gone up. My max risk hasn't really changed because I've narrowed the distance between the strikes. So the amount I'm getting is coming down, but the amount of risk I'm taking is not necessarily going up. So now we'll go down to 10, 10, and here, so I've reduced this by about the amount that I'm taking in by about 80%. I've reduced the max risk that I was taking by almost 30%. If you don't remember, it was about 10, 12 before we did this. And I've increased my probability of profit marginally. So is it as high as this one? No. But if you take a look at this, you can see that the risk-reward relationship is a little less asymmetric. It's still asymmetric, but a little bit less so. And I really don't like, I'm never that crazy about trades where I get into it and, I'm risking, let's just say for round numbers sake, we're going to say, okay, I'm risking $1,655 to make 345. And, what are the chances that it actually gets to this max risk? Well, actually, we can calculate that. And you can see that by taking a look at the delta of the options that are at the wings. So we can see the delta of this 830. That's 4 delta. And the 970 is 9 delta. So there's about an 11% chance that you actually see Costco move, at least this is the options market is implying it. It's about an 11% chance that you actually hit sort of your max pain, your max loss in this situation. So these are trades I generally like. And by the way, notice this shape. What does it look a little bit like? It looks a little bit like that strangle swap thing that I was talking about before. So you could, in that case, say, okay, 850, 950, I'm going to make all of these strikes the same now and turn it into a calendar and spread. So we're going to do this. So I'm selling these. This is just looks like nothing because it is nothing at this point, just buying and selling the same option. And quickly going to take a peek. When's the next estimated earnings for Costco? Second week of December. So December regular way would probably get the job done if I wanted it to. So I could just go out to December like this. By the way, for what it's worth seasonally, that's not a bad time to own stocks. And I end up with this. So as I was saying at the beginning of this, calendar, this is an estimate. With this, the condor, that is absolute, right? That's your break even. As of the close on September 27th, ignoring potential assignment issues, because all the options expire on the same day. You know the answer to the test at that point. On anything that involves a calendar, we're merely making an estimate of the longer dated options value at that time. But here you get into this structure, and you can see that, the probability of profit in this case says 90%. 90%. It's not 90%. I'm not saying that you're going to make $1,700 on $4,600 worth of risk within 90% certainty between now and Friday. If this was the actual math, then all of us should be just backing up the truck and doing this. Why is that math not quite right? Well, because there's that vol crush to the longer dated option. That will come down a bit, and that's not entirely baked into this cake. But I will tell you that your probability of profit is probably not far off of that condor trade to do this, right? So maybe 70%, this thing's going to be profitable. And this max reward is probably a little overstated, again, for the same reason. You're going to see a little bit of a vol crush on that longer dated option. This is another trade, though, I would like. Understanding, though, that this one's a bit more capital intensive. First of all, you always have to post whatever premium is involved. In this case, that's $4,600 for each and every lot you do. But this is another way to play it. So actually, this whole conversation, and thank you, Ranjana, for doing this. Your question, I'm getting a little bit of a cramp in my leg, forgive me. Your question prompted all of this conversation, and all of it is very closely related. So, good. All right, so it's just money. Who cares? Hello, Mike. Could you please comment on the positions with 35 SPX delta, 2,000 theta, and 12,000 vega? How to use gamma hedging with less transactions to benefit the positions? Okay, did I post? Okay, so I'm hoping you guys can see that. All right, gamma hedging. Let's talk about that part first. When you read the textbooks and when you think about what Fisher and Black were talking about, so options models are based on the concept of replication. So the value of an option is essentially derived in those closed form solutions just on continuous replication of the exposure of the option to the underlying. So as the delta increases, you adjust it continuously. That's the theoretical assumption that's made. In practice, we don't actually do that, or at least we did not. So when I say we did not, what I mean is that we did not hedge continuously. We hedged discretely. So if suddenly I was long a share's worth of deltas, or 10 or 50, I didn't go out and sell 50 shares or 10 or whatever. Instead, what would happen is we usually adjusted our deltas consistent with the relative size of the position. So for example, if I had 4,000 gamma in a stock. So what does 4,000 gamma mean? And by the way, there's different ways to think about Greeks. There's just straight gammas, there's dollar gammas. So I'm not talking about dollar Greeks. So when I say 4,000 gamma, what I mean is that if the stock went up $1, I would be long 4,000 deltas. And 4,000 deltas is the equivalent of 4,000 shares. So the way we used to do it before we started trading the whole thing as a bigger book and started thinking more about notional dollar deltas was 1 times gamma. So if I had 4,000 gamma, so I'm flat, stock goes up $1, I'm now long 4,000 deltas, I'd hedge it. But on the way, we didn't hedge it. So what that meant is that we weren't hedging that often, unless the stock was really whipping. And if it was really whipping, you're glad you were hedging because you're making money back and forth. Assuming it's whipping up and down. If it's just, gapping, then you hope that you didn't do anything, and then you hedge it at the end. When we started trading a much bigger book, where we were trading the index versus all of the constituent stocks, we actually hedged discretely in time rather than gamma. And what I mean by that is it was arbitrary. We just picked a time of day and just said we're going to true everything up across the book. So whatever deltas we have, it's 1:30, it's hedging time, bang, we would hedge it, and that would be that. And so that brought our hedging costs down. So that's one way you can you can think about it. In this particular situation, so we know that it's just money, who cares, is short options. How do we know that? Because he's collecting 2,000 theta, that's positive, and he's short 12,000 vega, that's negative. You're short options, right? So I would look at it in terms of your gamma, and probably just hedge it at something like 1 times gamma, or do it discretely once a day. Because if especially on the short side, it's painful, right? Every time it goes down, you find yourself selling, and every time it goes up, you find yourself buying. Maybe once a day would probably be fine. This is kind of interesting also. Bruno Dupire, he's the head quant at Bloomberg, and I haven't spoken to him in ages and ages. We had, but he is an acquaintance. We both spoke at a conference in Florida many years ago and had dinner together. Super smart guy, and he's done some. I mean, you can look him up. Dupire. I think he's the head quant at Bloomberg and has been for a number of years. He's done some very interesting work on volatility. He used to talk about, he gave the same presentation many, many times. And what he talked about was the fact that volatility does not adjust through time the way you think it should. And what that means is that in theory, if you're extrapolating on stock or index price action the way they did from things like geometric Brownian motion, so the movement of a particle, you would think that there's a fairly consistent mathematical relationship between the volatility over the course of 15 minutes, an hour, a day, a week, a month, and so on. And actually, that's not what his work found. What he found was that you are better off not hedging day to day and rather hedging weekly. Okay. So John C. said, can you explain the gamma comment, please? I explained it. Why don't we illustrate it instead? That might make it a little clearer. You guys are going to have to bear with me because for those of you a little bit less familiar, maybe this isn't 100% intuitive, but let me see if I can make it a little bit more intuitive. So in our example here, It's Just Money, Who Cares is trading SPX. SPX is SPX is the options that I prefer to trade when I'm trading index. It's the most liquid listed options there are. It's the biggest open interest notionally in options land. And they're European and they're cash settled. And those are, from my point of view, those are a favorable characteristic. Nevertheless, let's just use SPY because it's maybe more digestible size-wise. And we're going to imagine that you're trading, let's just say that you shorted a strangle and you're trying to trade it delta neutral. And we're going to say that it's 30 days out. So it's the 25th. We're going to go out to the 25th of October. And I'm just going to pick a short put, and we'll call it the 560s. We're about 570 now in SPY. So we're going to just say that you sell the 570, the 560, 580 strangle. Okay? And so just bear with me while I do this. So we're going to just get from the market what the Greeks for this position are in real time. Up delta mid, up theta mid. Let's get the vega in here too. Now, okay. Now, let me see if I can, I don't know whether you can see this. I'm going to blow this up a little bit more so we can get a better look. All right, so these are the individual Greeks, just the Greeks that he referenced, by the way, because there are others. And actually, the other one that I need to talk about is gamma. So he did not mention gamma, but I'm going to, so we're going to get that as well. Okay. Now, just a quick and important point when you are looking at your system. This is very commonly how you're going to see these numbers reported back to you. They're going to look something like this. These are reported in most instances back to you on a per share basis. And since the contracts represent usually 100 multiplier apiece, when you're actually trying to figure out what you're doing, you have to multiply each of these times the number of contracts you have and times the multiplier. And just so that we're looking at this, so this is the quantity. I'm going to put that in here. And I'm actually going to put the multiplier in here as well, although I'm only doing that for illustrative purposes. So if you owned 1 and 1, and the multiplier is 100, then your net delta, gamma, theta, and vega are all going to be those numbers that we have over here times the multiplier, okay? So it's that times, and I need to put a string in front of it so that I can just drag and drop. Okay, so this is the actual numbers. And then I can just sum these to get my exposure at any point in time. So, all right. So in other words, if I have one contract of this strangle, then I'm long 5.6 deltas, so that's the equivalent of 5.6 shares. I have 20 gamma, and that means that's how much my delta changes for every $1 change in the underlying. And I have, now this is important because he gave us some numbers that I think were relevant. He gave us 12,000 vega, and he said 2,000 theta. That's about 100 times as big as this, right? So this is not the trade he's in exactly, but, and why did that not recalculate? Oh, did I forget to multiply it by the quantity as well? Ah, okay. Perfect. Well done, Mike. That's thinking. All right. That does, so that has to be string F4. Now we're talking. Okay. All right, so this position, not exactly like the one that was being discussed here, but it's similar, right? We don't really need to get the pennies. This is the part we're most interested in. So this position, and actually he's short, sorry. So we're going to actually replicate what he's got. And again, these are not the positions he has, but this is for illustrative purposes. So short 12,000 vega, round numbers, right? Collecting 2,000 in theta, again, round numbers. Delta, short 562 and short 2,000 gamma. So what did I mean by hedging my deltas at 1 times gamma? What I mean is that I would not affect a hedge until the delta number was the equivalent of my gamma number. So if this goes, and when would that actually be the case? So I'm short 562 now, deltas. My gamma is 2,000. So what I'm saying is I am going to hedge my deltas once my deltas get to about 2,000, which is what my gamma is. Well, what do we know? We know that the gamma reflects my change in delta for a $1 move. Now, it's not linear, but give or take, that's 75 cents higher. If SPY goes 75 cents higher right here and now, I'm going to be short about 2,000 delta, which means that if SPY rises by about 75 cents, I'd have to buy 2,000 shares of SPY to hedge this position. Now, this position is pretty big, right, for a retail self-directed trader, because 2,000 shares of SPY is well over $1 million worth, right? So that's $1 million deltas. In fact, it's actually much more than that. So I'll give you the exact. It's going to be two. If I'm doing it exactly times my gamma, it's going to be 2039 times 570.75, give or take. So 1.16 million. And that actually that's how dollar deltas are, right? So dollar deltas are just your share deltas times the price of the underlying. So that's the difference. And if you ever hear options traders talking about dollar deltas, that's what they're talking about. Now, it's funny because what's helpful about that is that if you have a whole bunch of positions and you know that I'm short 50,000 deltas over here and I'm long 100,000 deltas, it's a lot easier to normalize it. Now, you might want to normalize it still further by doing things like adjust for beta. When you normalize gamma, though, you don't do it that way. You don't, because $1 in SPX is 10 times different than $1 in SPY, which is significantly different than $1 in Accenture, right? Because these are all different priced underlyings. So when you normalize gamma, you normalize it to a percent. So you'll often hear options traded, and I realize we're getting a little bit more into the deeper end of the pool. I apologize for that. But just so you guys know, that's all that we're really talking about, is we're just trying to come up with reference points that can apply across underlyings. Things that you don't have to think about normalizing in much the same way, theta, because that's just dollars. It's how many dollars. So this position, all else equal, I'm getting about $2,300 a day in positive decay. Vega, when we normalize Vega, the only thing we're doing is we're thinking about Vega's sensitivity to some anchor vol change. And again, I realize this all sounds complicated. You don't have to worry about this. If you guys are interested in these types of questions, I can dig into them more deeply, or maybe we'll have separate breakout sessions where we get into more complicated things. And this is just the primary Greeks. There are also secondary and tertiary Greeks where we talk about, the sensitivity of sensitivities. So what's the relationship of delta to the passage of time? What's the relationship of vega to the passage of time? What's the relationship of, these different things? How does gamma change as a function of the changes in implied volatility? Those are secondary and tertiary Greeks. But for most retail trading, it's not that relevant because we're really starting to split hairs, and it's bigger things that are really going to drive your profitability, actually, like getting the direction of the stock right. That's the primary sensitivity that you're usually going to have, and the one you should worry about first and foremost. These other things are splitting hairs. Okay, so I hope that did make it a little bit clearer, though, right? So hedging delta, 1 times gamma, that means if my delta gets to 2,000, that's how much my gamma is, then I would hedge at that moment, and I wouldn't hedge again until I got up to a number of that magnitude. All right, so I hope that helps. And I realize we just sort of went into the kind of the deep end here because I realize most of you are not gamma hedging. Okay, interested in learning about the 112 trade structure and what underlying to use with it. Seems to work on the E-mini futures. Can it work on individual stocks? This is from Greg Forrest. 112 trade structure. But I'm not 100% sure. I don't actually know what you're referring to. So it maybe just be a little bit, maybe I have a different name for it. But yeah, you might need to elaborate on that. But I will say this, generally speaking, that options trades that work for one underlying can be applied to another, and often do. I will make this point, though, and that is that there is a functional relationship that exists between something like an index, so like your E-mini futures, and the individual stocks that comprise the constituents of that index. So I'm very, very interested in the implied volatility of constituents to the index. That's, again, a deeper end of the pool conversation. It's part of the correlation and dispersion trade that I've referenced once or twice. But that is just an important thing to think about, that I don't just say, oh, S&P, and think about that wholly independently of the constituent stocks that are in the index. I'm very interested in the relationship between 112 is in, okay, oh, someone has posted that for me so I can find out what we're talking about. The combination of a bear put spread and 2 short put spreads. So long a put closer to the money, short put further from the money, and 2 more short puts even further out of the money. So long one, so basically long a put spread, and then short 2 put spreads. Okay. Interesting. So we'll illustrate this really quickly, and then I just want to talk about something that's, I think it's kind of, I guess it's kind of important. I guess we're really getting into it time-wise, but oh, we're an hour and 20 minutes in. Wow, we really have chewed up the clock, haven't we? Okay, so if somebody wants to stick around for this, for those of you who don't, and you've already stuck around as long as you have, I appreciate your time. And the WD-40 I put into this chair did not do enough for it. I've ordered some grease for the pistons in this thing. Maybe that will quiet this chair down a little bit more. We'll see. Okay, so an important point I would make is that, you know, vol traders such as myself, market makers and so on, because we would, you know, eventually accumulate really fairly complex positions in the underlying stocks that we traded, because you're making markets all day long. So people are buying and selling options from you all day. If you're trying to trade vol, you're usually trying to do it in a way that you flatten out your vega. So you're trying to trade strips of options and things like this. We don't really think about things in this sort of, you know, 1-1-2 context, but we'll illustrate one anyway. You know, once you ended up with a lot of positions, we would actually just look at everything in terms of synthetics. And we just basically have a matrix. So time would go across the top, strikes would go up and down, and we would just net out all our long and short options. So didn't matter whether it was a call or put, just mattered whether it was long or short. We would net out our exposure to every strike because we're hedging everything delta neutral anyway. So this 1-1-2 thing that you're talking about isn't a concept that I was really familiar with, because it wasn't something that, you know, we didn't initiate trades in this way. We were really more interested in trading the vol side of it. But let's just take a look. And I don't know whether we want to do it in Costco or something else. Why don't we just use SPY, because it's probably pretty easy. So what we're going to do is we're going to buy put spread, and we're going to make it, oops, this is not what we want. So I want a long I'm going to just make a long 570. I'm going to go short a lower, and I don't know if you have any specific deltas that you're interested in, but I will pick, so we're long the 570 puts, we will go short, I don't know, 560s, why the heck not, just make it $10 wide to get things started. And then we're going to short 2 more puts. Let's see, 1 long put closer to the money, that's right, short put further from the money, yep, and 2 more short puts even further out of the money, preferably maintaining a credit. Okay, so we could, in theory, I guess the way that's being described to me, oh, I guess we could do 2 of these, right? So let's try to do this so that we get a credit, as was referenced here. So we can see the premium spent over here is about $3. So we want to collect at least 3, but we're getting it twice, so it doesn't have to be something like this. If I went down to, say, 520, I'm going to collect $3. Okay? So now you get a structure that looks a little bit like this. So long, Brad. I see you've got to run, but thanks for joining us today. Okay, so probability of profit for this trade, 96%. you make money anywhere above the downside break even, which in this case is 513, and that's, in this case, we're looking at the end of November expiration, and that's with the S&P at 5,700, so down to 5,130 or thereabouts if we're converting it to S&P terms. Pretty big decline, right? So you're talking about a decline of about 10% in this example. So as long as the S&P is not down more than 10%, this trade's going to be profitable. So I can see what the appeal would be. The appeal is that it has a very high probability of profit. And there's another thing that's appealing about it, and that is that you get this little boost in here. So if it drops, you actually, by some modest amount, like 5%, you actually make money, right? You're going to make the distance between the strikes, which is $10, plus the premium that you spent, collected, excuse me. So you're $3. So you actually could make $13. That's the appeal of this. I would say, though, that what you're really doing is reshaping a short put trade, right? So let's talk about the max profit that you can get here. The max profit that you can get, because you're net short puts. So you're just taking the balloon, if you will, and squeezing it a little bit, but you're still net short puts. At the end of the day, you're net short puts. And the reason that's important is because if disaster strikes, that's the way you should think about your exposure. And, you know, another way to think about it, though, is that the probability of those kinds of moves is relatively low. The market is generally, over any 30-day period, this is a slightly longer period. I should probably have modified this to go out 30 days because most of us probably thinking, you know, time frames like that. So here, you're still collecting a credit, going out only 30 days. Now it's a much more modest credit, but still, you know, you have max profit of almost $11 because remember, it's the value of that long put spread plus the premium collect, which is 90 cents. So $10.90, that's your max profit in this region. But, you know, you still have a, well, actually, no, this was laying out 90 cents, it looks like. So forgive me, but that's why that probability of profit went down. But so we would have to bump this strike up a little. Maybe to here, a little higher. We'll go, okay. And it looks like the producing staff is running out of time. But this is the thing I want you to think about. All you're really doing is taking a short put trade idea and squeezing the balloon so that you get a little bit more juice out of it in some areas and increase your probability of profit in some areas, but you're taking more risk in other areas. And what this is really doing is you are basically making a trade-off of a modest move, you're really short vol, against a really big move. And actually, you're taking the opposite side of how fat-tailed the distribution is going to be, right? So you're essentially saying it's going to be in this relatively, there's a high probability it's going to be in this narrow band where I'm profitable, and I'm discounting the value of these really outsized moves. It's another moment of a distribution. So you think about the normal bell curve. When it gets narrow in the middle, tall, with fat tails, that's leptokurtic, is what we call that. So that's kurtosis, what's going on at the wings. And if there is more kurtosis in securities prices than a normal distribution illustrates, then it's priced into the options. That's why the implied volatility of those downside puts is so high. But if you think there's a possibility of a market crash, this is the trade you'd rather buy than sell. So I'm going to leave it with this. Okay, so John C. was asking what the strikes were again for this trade. In the case of the November expiration, I was using, and again, I apologize that I'm going to have to cut it short here simply because I was, you know, I'm chewing up the clock not only of my own time, but the other people who are involved in producing this. And got everybody going much longer than I expected. So I was using 570, 60, 30, and the downside break-even is 522. If you go down to 520, which you can get away with, there you go. Yeah, so 520. 570, 60, 520. So you're collecting a credit for this, and 95, 96% probability of profit, and a downside break even is a 10% decline. So as long as the S&P is not down more than 10% between now and November expiration, in this particular example, it would be profitable. This isn't really a trade for me, I have to say, because I'm not crazy about selling disaster insurance. But there are other ways we can think about doing that. We're going to have to do that at another time, though, because I have more than chewed up the clock for all involved, including Jeff and Brad, who are the unseen faces that help put all of this together, and whose time I really appreciate, but didn't appreciate enough to let them go when they needed to today. But for all of you who stuck around, and to them also, thank you very much for watching and participating. And I look forward to joining you guys on the next one, the regularly scheduled one, which is going to be on Monday at 4:15. But we might try to get a little something in ahead of Costco or one of these other things before the end of the week. Thanks for watching.